We're going to work on Buzzer Inc., a retail store that needs a cash budget for March. Well, first, what's in a cash budget? Let's go down here and look. A cash budget would have inflows, sometimes called collections, receipts, or deposits, anything that increased cash. And the most typical and the largest one are collections from customers, either from cash sales or credit sales that are later collected. There may be other inflows. They would have to tell you about them if there were, maybe proceeds from getting debt or some other activity. Then the other piece of a cash budget would be the outflows, sometimes called disbursements or payments. And those for a retail store, the largest one is probably the payments for inventory. Then there would be payments for operating expenses, payments if they bought any long-term assets, and payments if they paid dividends. There may be other outflows. They would have to tell you about those. They may repay debt. They may have other payments in the month that they're expecting, taxes or who knows what. They would have to tell you about them. And then the difference between what came in and what went out would be the net change in cash. So if this was an easy problem, they might just tell you collections from customers was a certain amount and payments for inventory were a certain amount. And then you could just build it. But here, they don't tell us that. We have to figure that out. What were the collections from customers? So let's work on that particular problem first. So we're going to work on this cell. What goes into this cell? We see here that sales are expected to be collected over a 3-month period. That means that sales are not cash sales because cash sales happen they're cash right away. So these must be credit sales that are going to be collected over a period of 3 months. 40% in the month you sell it, 45% in the next, 10% in the next. All right, so let's go over here. I've got a little schedule started. Let's work it. So January sales, when am I going to collect them? Well, I'm going to collect the first part of January sales, January's credit sales, 40% in January. I'm going to collect a little bit more of January's credit sales in February. How much more? 45%. How about in March? I'm going to collect the last piece of January's credit sales, 10% in March. Now for the cash collections, I'm going to get all of the cash sales in January. All right, let's do February. When am I going to get their credit sales? Well, I'm going to get 40% of those sales. There's the credit sales. There's the amount I'm going to get in February. What about in March? In March, I'm going to get some of the credit sales. How much? I expect to collect 45% of them. How about in April? Well, I'm only interested in March, so I don't really have to do the future months, but you could if you wanted to. You could do the 10%. How about March sales? When am I going to receive those? Well, I'm going to get the first chunk of March credit sales in March. And I could do April and May if I wanted to, but I know that I'm just doing March's cash budget, so I'm only interested in this column. So those are the collections from credit sales that will occur in March. The cash sales, of course, are going to happen right in the month that they're sold. And since I'm not interested, I don't have enough data to do January and February collections, and I'm just trying to do March's budget. So this is enough. So let me add up both the cash from cash sales and the cash from credit sales, and I get 635. So now I know what I expect to collect from customers in March. I don't have any other information on collections, so that's the total for March. Now I'm ready to work on payments for inventory, and I've got a little schedule over here and we will build it. So here's payments for inventory. So the first thing they tell us is what inventory that's sold, what it's going to cost us. All right, so let's see. Inventory costs are 40% of the sales price. All right, so total sales in January was $500,000, and it's going to cost us 40%. So that's the cost of what was sold in January, February, and March. Now, when are we going to buy what it is we sold? Okay, so for instance, what if we had to buy a month in advance? Then we would buy in January what we sold in February. And what we bought in February would be what we sold in March. That would be a 1 month stagger. But that's not the facts in this particular problems. They tell us inventory costs 40% of sales price and is bought in the month of sale. So we would buy that $200,000 in January. What we sold, we would buy it in January. So that makes it a little bit simple, so that the purchase happened in the same month as the cost of goods sold. Then when are we going to pay for that? When will we pay for that $200,000? So January purchases will be paid half in January and half in February. They tell us the stagger over here. January purchases are paid half in the month. It purchased and the rest the next month. So January's purchases are paid half in January and half in February. February purchases, half in February and half in March. And March purchases, half in March and half in April. I'm not going to bother with April since I know I just need to sum up the payments that would be made in March. All right, let's put that in our cash budget. So there's our payments for purchases. So that took quite a big schedule to map that all out. Now, payments for operating expenses. Let's see, operating expense budget is $175,000 in March, but that includes $10,000 of depreciation. Well, you don't write a check for depreciation. You write a check when you buy the long-term asset, but then as you spread the cost across the periods of use, you don't write the check again. You've already written it at the beginning. So I only have to put $165,000 in here because those are the checks that I'll write for operating expenses. So I removed the $10,000 from the $175,000, and that left me with operating expenses that needed to be paid. All right, we plan to buy equipment in March, so we'll be writing a check for equipment for March, and we will be writing a check for dividends in March. They don't tell us about any other payments, so we can add these payments up, and we get $500,000. So the cash collections of $635 is bigger than the payments of $500. So the difference will make cash go up. So in this case, we have free cash thrown off in the month of March. We can use to repay debt. Now, if this had been negative, if the collections were smaller than the payments, we might have had to go get a loan, and you might have predicted for your client how much loan they would need to cover March activity. You can download this in D2L and work it on your own and then come back and review it for additional guidance.